Hello and welcome to this IBP for Finance series of videos from GitaCloud. This part 3, Variance Analysis, is aimed at finance and IBP practitioners. We showcased performance planning aspects in part 1 and 2 of this video series, the ability to generate projected financial statements from granular demand or supply plans. Let's focus on the performance management aspects in this part 3. We use variance analysis to understand how actual performance differed from planned performance. Variances are calculated as actual cost minus budgeted cost. Negative values for variances are favorable, as this means that actual costs were lower than budgeted costs. Significant variances should be analyzed for root causes and corrective action. We will compare 2022 actuals with budget to showcase variance analysis. We need to first introduce flexible budget as a key concept in variance analysis. Flexible budget is a revised budget to adjust projected costs for the change in actual output, for example, if we sold more finished goods than budgeted. Note that we sold 210,000 units in 2022 instead of 200,000 units budgeted. We also ended the year with 4,000 units of FG inventory, as opposed to the budgeted number of 4,400 units. This gives us a flexible budget of 210,000 for units to be produced. See quarterly values and calculations for production budget versus flexible budget in this view. You may wish to pause the video to fully understand these calculations. We can get production cost variances from many sources, such as direct materials, direct labor, variable overhead, or fixed overhead variances. Let's focus on direct materials variances in this view. These can be price or quantity variances. See calculation explanation on the right to understand how these variances are calculated. We have an unfavorable price variance of $88,000. This is because we purchased direct materials at $1.20 per pound, which is 20% higher than our budgeted standard cost of $1 per pound. We have a favorable quantity variance of $21,000, as we consumed only 399,000 pounds of direct materials versus a flexible budget of 420,000 pounds. Performance management is a function of quantifying impacts due to multiple root causes. We may find that we had a material shortage for the material grade budgeted, resulting into needing to buy premium materials, which came at higher prices. This makes sense as such premium materials likely reduce the scrap rate in production, and allowed us to use less materials than budgeted. Let's focus next on direct labor variances. These can come from rate variance or efficiency variance. Rate variance comes from paying higher or lower hourly rates than budgeted. Efficiency variance comes from needing higher or lower labor hours than budgeted. In this example, rate variance is unfavorable. Actual rate of $15 per hour is higher than budgeted rate of $13 per hour. Efficiency variance is favorable. Actual hours are 18,900 versus 21,000 budgeted hours. Again, root cause analysis into these variances might tell us that we hired more experienced staff, leading to higher labor rates. More experienced staff needed fewer hours than budgeted. This largely offset the higher cost of experienced staff. This may also be the likely reason we experienced lower scrap rate, as we used less material in production than budgeted. Lower scrap rate could also be due to premium materials we had to buy. It's important to quantify contribution of root causes for a given variance number. Now let's focus on variable overhead variance. This can come from spending variance or efficiency variance. Note that we chose to allocate variable manufacturing overhead to FG products based on direct labor hours. Let's review our final variance type, fixed manufacturing overhead variance. This can come from spending variance or volume variance. Note that fixed manufacturing overhead does not change based on actual volume. See a management view of all the variances. Not all unfavorable variances are significant or worthy of management's attention. In this example, direct materials price variance $88,000 is significant. Direct labor rate variance $37,800 is also worth investigating. Next we will discuss how to manage by exception by identifying significant variances. Executives should define variance thresholds and help focus variance analysis efforts on understanding root causes behind significant variances. We define significant variance as a variance greater than 12% of the corresponding flexible budget value. See below a view of Planner Workspace in SAP IBP. We can showcase custom alerts along with their underlying data in both tabular and visual forms with this interface. As you can see, only direct labor rate variance and direct material price variance qualify given our 12% threshold. You can see custom alerts have been raised only for these two variances. In conclusion, we showcased an integrated approach across performance planning and performance management by leveraging variance analysis capabilities right within SAP IBP. This enables a drill down from the overall business level all the way down to individual SKU or resource level to understand root causes for significant variances. See Part 4 of this series to understand how to develop an executive scorecard focused on business and financial performance, not just supply chain performance. You can find more such explainer videos at GitaCloud website or GitaCloud YouTube channel. You can reach out to GitaCloud team if you would like a detailed demonstration of this unified planning model to enable corporate performance management in SAP IBP. Hope you enjoyed this video. Please like and share if you did. You can also subscribe to GitaCloud YouTube channel. Thanks for watching. Have a great week.